North American markets appear poised to open lower, and oil and natural gas prices are surging after another round of attacks on Middle East energy facilities. Our next guest, though, says markets are proving more resilient than some would expect, given major geopolitical shocks. Joining us now is Christine Tan, portfolio manager at SLGI Asset Management. It's good to have you join us. Good morning.
Good morning, Lindsay. Thanks for having me.
Yeah, thanks for coming on. This is an interesting take. Where are you seeing the most resiliency in the markets right now?
It's more about, when we made that comment, it was more about the relative considered to what the headline risk has been. Markets have been quite resilient. You're seeing a little bit of rotation underneath the index level. And what you're also seeing is more differentiation between the different countries. So, for example, Asia and Europe, clearly much more impacted directly by actual supply disruption. So there are two parts of what's happening as a result of the Iran war. You've got prices going up, but then you actually have the physical disruption of supply impacting Asia and Europe. And I think what we're, sort of watching very closely is markets have actually been quite resilient, again, relative to the shock. And part of it is we believe right now the view is still perhaps this is a bit of a transitory or like we would see a bit of a resolution sooner rather than later. And there's also the thought that perhaps this stays a little bit more contained to more energy prices. What we are more sort of watching very closely for is if this does extend longer, and you just spoke about how we've seen some strikes on actual oil infrastructure. If this does get a bit more extended, you start seeing second-order effects. For example, we do get a lot of nitrogen-based fertilizer coming out of the region that's being disrupted by what's happening at the Strait of Hormuz as well. So these are not factors that are necessarily being priced in fully in our view, and that's kind of what we meant when we said markets look more resilient than given the geopolitical noise that we're seeing.
Okay, I take your point. Resilient given everything we're seeing geopolitically right now.
Exactly.
And I also, I heard you when you said as well, if this becomes more of a long-term situation, what we're seeing in Iran and in the Middle East, things could change. What do you think the oil story is short-term, or do you think we could see long-term supply issues here?
If we were having this conversation 3 days ago, I would say that perhaps it is more of a short-term disruption. But given what's happened just in the last 24 hours with Israel hitting the natural gas field in Iran and Iran sort of responding by hitting some oil assets in some of its GCC neighbors, we are sort of starting to step into another phase of this conflict. So it is a little bit worrisome. It is something that we want to watch very closely, because what we've said sort of 3 days into the conflict is there were two scenarios that was kind of our base case, if you want to call it that. One, it was going to be very short strikes, basically remove capabilities, nuclear capabilities of Iran, and then you sort of start moving towards some sort of longer term agreement or truce. Second case, which is kind of where we've been for the last week and a half, is it's a much more extended conflict. But what we had identified at that point in time was the third, what we thought was a low probability outcome, is actual disruption of oil and gas infrastructure, which means that even after this conflict is resolved, you're going to see a permanent impact on oil and gas supply because infrastructure has been damaged. So that's probably what our concern is. In the short term, the market's still kind of focused a little bit on short-term disruption. Coming into this conflict, we were in oversupply in the market, in the global market, so that's why energy prices were quite contained and probably on the weaker side. But we are now moving into a different phase. So medium term, there is a real risk that infrastructure, if it is damaged, that we physically will have a little bit more of a permanent disruption of supply.
It's such a good point that even when this is all over, whenever that is, there's still going to be a lot of pieces to pick up, as you say, a lot of infrastructure damage so far. Is there anywhere that investors can go that you think is maybe like a safer bet right now in terms of sectors within the market?
So our message has been to not overly react to what's happening in the market. So we're kind of still sitting in the camp that we believe there is a resolution at this point. And you are seeing an escalation in terms of hitting infrastructure. But we still think most parties that are involved, and we heard overnight, President Trump has called for a de-escalation. So certainly the base case is there isn't a desire to necessarily really take it to a very extreme escalation. So based on that scenario, we have been speaking to clients about not overly de-risking, but really revisiting their portfolio and thinking more intentionally about their exposures. We've seen certain asset classes in certain regions do extremely well over the last 12 to 15 months, and maybe it's rebalancing away from some of that outperformance, but not de-risking in a meaningful way. I think what's more interesting is the traditional safe havens, if you will, which is fixed income. It's not really working the way it's intended because this is a inflation risk potentially, and what you've seen is the back end of the bond yield curve move up. We've also heard from the central banks, Bank of Canada, Fed Reserve. We're going to hear from ECB today. They've been quite cautious. They've actually been, no one's really made any significant moves in terms of interest rate decisions. And the view is it's watch and see mode at this point in time. I would say, if there is one tiny pocket of potentially resilience within, let's say, the U.S. market, it would be some of these tech names where they are less directly impacted by what's happening in the Middle East. But again, if we do see a more protracted conflict and if we do see energy prices stay higher for longer, we do know that AI, for example, requires a lot of energy as well. So it really depends on your sort of view of the time horizon of how quickly this resolves itself. But we are basically cautiously around the edges, kind of rebalancing the portfolio. We're not making any big shifts. On the positioning front, we've had a tactical position in gold for several quarters now. That was working for a little bit. In the last few days, it's been sort of pulling back a little bit more because of potentially stronger U.S. dollar, and maybe there's a reflection on what the growth prospect would look like for the world. We have a sort of a strategic overweight to commodity, the oil as well as a commodity, so that's been working well for the portfolio. But those are kind of some of the tilts that we had coming into this.
Right.
What we did do is reduce our EV exposure just a little bit, again, with the view that that is a part of the global index, a global market that's going to be much more affected by an extended disruption in the Strait of Hormuz.
Christine Tan.
But overall, keep calm and sort of stay diversified has been our main message.
Okay, we'll have to leave it there. Christine Tan, Portfolio Manager at SLGI Asset Management. Appreciate your time today and your insight. Thank you.